Hey, you guys, it's Jennifer Reynolds. I am going to talk about depletion. So, the first thing I want to quiz you on is what type of assets get depleted as opposed to amortized or depreciated? So, it's still tangible assets, but natural resources. So, some people get confused and think maybe natural resources aren't tangible, but think about it. You can hold them, touch them, they're tangible, just like equipment and buildings are. But these resources can be completely depleted. In other words, we can get all the oil out of the ground or all of the gold out of the gold mine. Whereas, like a building that's depreciated, we depreciate it over 30, 39 years, but it's still standing, right? So, same concept, it's cost recovery. We're expensing the cost of this long term asset. We just call it depletion. There are two different methods of depletion for tax purposes. So we can use cost depletion and percentage depletion. The taxpayer can choose one or the other, and they can change this every year. So a lot of things in tax, once you choose a method, you got to stick with it. But depletion, they let the taxpayer choose whichever's more advantageous. In other words, whichever one's a larger deduction each year. And again, that's kind of an uncommon thing in tax. So we're going to go over some examples. Cost should be really easy. Percentage is going to be something new for you. Sorry, I'm trying to get my document camera working here. All right, there we go. You can see my desk and everything. So here's my document camera. Um, And I said, there's going to be a lot of special, or read this, different rules relating to natural resources than there are other types of assets. And why are they treated so specially? A lot of it, remember, Congress makes these tax laws. Congress is encouraging the U.S. to explore and try to find our own energy sources so that we're not dependent on other countries for our energy sources. Okay, so here's what I told you already. You should be able to name those two, and taxpayers can switch back and forth to choose whichever one offers the larger deduction. So let's start with cost. This is like the activity method, or we call it units of production method that you learned in that baby principles of accounting class. You just take the total cost of the thing you bought, like mineral rights to oil and gas, and you divide it by that estimated total units. The reason that sounds so vague is because it depends. If you bought a timber forest, you would divide it by how many estimated trees you're going to get out of that. If it is, sorry, I'm going to touch this and see if that'll get it a little. There we go. Hopefully that's a little clearer. If it's you bought the mineral rights to some oil and gas under the ground, then you're going to have a geologist come in and say, hey, I think you're going to get this many barrels out. And whatever the cost divided by how many barrels of oil or whatever is, that's your per unit depletion cost. Again, just like we did in financial. Then you multiply that by the number of units sold. I underlined this and made you guys fill that out for a reason. We'll talk about that in a minute. Ralph acquires an oil and gas property interest for $100,000 in 2024. So in case you didn't know, when you buy land, it doesn't mean you own the rights of any minerals that might be underneath that land. You only own surface level. You would have to purchase the mineral rights for what's under the land separately. So he purchases mineral rights for 100 grand. The geologist came in and said, hey, I think we're going to be able to get 10,000 barrels of oil out of that for you. And then later on, only 3,000 units were produced this year. That means we actually got them out of the oil, out of the ground and produced them. And only 2,000 were sold. So we've got a lot going on here. And my first question is, what is the per unit cost depletion amount and the total cost depletion amount? Okay, so I've got my calculator here. These are really easy numbers, but you're not always going to have really easy numbers, right? Per unit, we just take the total cost of 100 grand and divide it by not what we produced this year and not what we sold this year, but the total amount, like all of that oil and gas under the ground, which was 10,000 barrels. And that would get to what? $10, oops, left off my one, per barrel that they're going to get out of the ground. Okay. That's like if you go to the store and you see, oh, Dr. Peppers are $12 for a case of 12 of them. How much does each Dr. Pepper cost? Oh, okay, $1 for each one. That's all we're doing there. You don't have to memorize that formula. That should just make sense. All right. What is the total cost depletion amount? In other words, how much can this company deduct this year for their depreciation? Ultimately, that's what depreciation is, right? We're expensing out the cost of this whole asset. Well, the reason I underlined this and wrote in sold is because when my students make a mistake, here is usually where the mistake is. They can deduct $10 per barrel times what? How many were produced or how many were sold? And it's how many were sold. So their cost depletion amount this year, again, their deduction for depletion expense would be $20,000. Okay, what is their basis after the depletion? Well, remember, your basis gets reduced because ultimately what we're trying to do is expense all $100,000 of these mineral rights we bought. So we would take our total cost of $100,000 minus our depletion that we took this year, and that means we've got $80,000 left of this asset to continue to expense out each year until we have recovered our cost. That's why depreciation chapter is called cost recovery. Okay, again, that one should be a whole lot easier. Here's where most students make a mistake if they're going to. This one is new. This is just a tax thing. And it's got a lot of nuances to it. So follow me all the way through to the end here. Percentage depletion. This is something for what we call smaller companies. It's not available to larger oil and gas producers like Exxon or Shell or whatever. So what you do is you take a percentage rate that's actually given to us by Congress and you multiply it. Again, notice I've got an underline here. That's telling you, uh-oh, she's emphasizing that. That must be because a lot of people make mistakes there. You multiply it by any gross income created from that property. So you guys don't need to memorize a percentage depletion amount. I have oil and gas memorized because we use that so much in Texas, but I'm actually going to scroll to, let me see where this is in my book and kind of throw out some real quick so you'll know. Shoot, I can't get to it quickly. But anyway, if it's a gold mine or a timber mine or a copper mine or a salt mine, the government is who tells us what these percentage rates are. But for oil and gas, it's 15%. Notice I've got some other percentages here too. These are limitations. So the total percentage depletion, after you figure it out, is going to be limited to 50% of whatever the taxable income is from that property. Or though in your book, in this book that I use for my class, it's got a little asterisk if they still do that now. And it says, or 100% of your taxable income if it happens to be oil and gas. So in my class, I'm only going to test you on an oil and gas natural resource because in Texas, that's what we see the most. We have clients that have properties maybe in Louisiana, New Mexico, Oklahoma, but we see a lot of oil and gas stuff. So in the current year, Carmen acquires for $400,000 an oil and gas property interest. So this is her original cost basis. That's what she paid for those oil and gas mineral rights. They think that she's going to get 200,000 barrels of oil out of it over the years. I don't know how long it's going to take her. But during this year, 10,000 barrels of oil are sold for $250,000. And let me go ahead and do like I did up here. And let's say 12,000 barrels were produced, but only 10,000 were sold. Okay, IDC costs amount to 100 grand, and she elects to expense them in the current year. I'm going to come back and talk about what these costs are in a minute, but for now, just know these are an expense. And then she's got some other expenses of 50. First of all, let's do this method up here that we learned about, the cost depletion. What is her total cost? It was $400,000. And what is her total amount of units that she thinks she's going to recover? 200,000 barrels. So that's $2 a barrel. That'd be a great deal. Oil and gas is a lot more than that right now. But it'd be $2 a barrel. Okay. $2 a barrel times what, y'all? Times all of that, or the produced or the sold. It's times how many ever were sold. And we sold 10,000 barrels of oil. So barrels sold. That would be $20,000 for her cost depletion. Well, what you have to do every year is you've got to figure out the cost and the percentage depletion, because we can take the larger of them. All right, let's work on this percentage. This is the new one. The percentage depletion before the taxable income limitation, we take, remember what it said? It said take 15% of gross income from property. This is important. I want you to stop the video and write down what the gross income from property is. This is the first step where I see my students make some mistakes. And for some reason, I think it's because y'all are just thinking, oh, what's this new tax and percentage stuff we're doing? Y'all forget that you've known since Principles of Financial what gross income means. Gross income is not 400 grand. It's not 200,000 barrels. It's, here it is, sold for 250. So I would go ahead and label that right off the bat. That's not net, that's my gross income. So 250,000 of gross income times, I will give you 15% because Congress tells us that. We didn't just pull that out of the air. 250,000 gross income times 15% rate for oil and gas, OG rate, equals 37,500 depletion deduction. But wait, there's more. Notice whatever you get for cost depletion, you get what you get and you don't throw a fit. That's the end. But with percentage, we have some limitations we need to apply. We may only take this if it does not exceed more than 50% of our taxable income, or in this case, since it's oil and gas, 100% of our taxable income. Again, y'all know Principles of Financial Accounting and Intermediate. How are we going to find taxable income on this problem? Well, we always start with gross income, and then we just reduce all of our expenses, right? Okay, so what do I have? I have IDC expenses of $100,000, IDC expense, and I have other expenses of $50,000, other expense. That leaves me with $100,000 of taxable income before the depletion expense, right? That's what we're trying to figure out. What's our depletion going to be? Well, remember up here it said I cannot take, because we're using oil and gas, here's my depletion deduction, and I can take that as long as it is not more than 100% of the taxable income before. Well, it's not in this case. So I'm allowed to take all of that. So now I go back and compare these two. I'm going to say, not limited. So now I can come back and compare these two and choose whichever one's larger. And I would choose the larger one this year. So, sorry, I can't watch my screen at the same time. I'll put it there in case you need to pause your screen and look at anything. So several more things to consider. Let me flip back over here. One, I want you to make sure you work a problem where it does end up being limited, because it's one thing to know that rule in your head, but it is quite another to be faced with it on an exam or real life and go, oh yeah, I did all these calculations, but I can't take all of that. I ended up getting limited because my taxable income was less than that 37,500. So here's a couple more things that are in your book, but I want you to know about, because this is new for most people. We've just now learned about depletion for natural resources. That's for the cost we paid for those mineral rights. But let's take oil and gas, because again, we see that a lot in Texas. What about, okay, I've got this business and now I have to go in before I can even get that oil and gas out of the ground. I've got to clear that land and bring in people to start digging the hole to get down to the oil. What about all of those costs? What are they? Those are your intangible drilling costs. Remember that IDC that we just worked in a problem? So far I've talked about the mineral rights itself being depleted. Now we're going to talk about IDC. What do we do with those costs? Well, Congress actually gives us a choice. We can either capitalize them. Y'all know what that means. It means record it as an asset with our mineral rights, capitalize them and expense them out as we expense out that with depletion, or we can just immediately expense it. Most people choose to immediately expense it. You'll see why in just a minute. For one thing, we like to take our expenses as quickly as possible, often if we have income, but there's another important reason in a minute. Then we have a third thing. What about a bunch of equipment? We remember we got to dig that hole and the well gets up and going. I've got people bringing in tools to dig, and I've got to build a fence all around it to make sure nobody comes in and disturbs the property. So those are your regular tangible assets. Again, just like you learned in principles or intermediate, we depreciate those. So I'm up to three things now. My mineral rights I depleted, my IDC cost I can capitalize and deplete, or I can expense immediately. Now I'm to the tools and equipment, and those are depreciated just like any other tools and equipment. Now I've got one more cost, operating cost. Now my well is up and pumping, and I've got maybe even utilities expenses related to keeping that oil derrick going, labor costs, whatever. Once the oil rig is up and going, regular operating costs are expensed, just like in any other business, your operating costs are expensed. So I think sometimes students get a little confused and shell-shocked with this just because you're trying to wrap your head around what oil and gas or what a natural resource is, but really you know a lot of those things already. You know that natural resources are depleted. You know that equipment is depreciated. So you know that operating expenses are just expense. So let me bring you to the last thing. The last weirdo thing about depletion is that if we have cost depletion, we keep reducing that basis, just like I showed you in that problem, every year until it gets to zero, and then we're done. Just like any other asset, we can only expense the cost of the asset, right? Well, because like I said, the US wants us to have our own energy resources, they give you a really big bonus with depletion, and only with percentage, not with cost. They said, even if you have depleted those mineral rights, what did we have in that problem? 400, that last problem we had 400,000 that we did. Even if we had depleted all 400,000 of that cost, that means I have taken a deduction for all 400 grand. They will still let you keep taking percentage depletion. It's one of the very few assets that we can actually deplete more than what it cost us. What does that mean? We can deplete more than what it cost us. We can take more deductions than what we actually spent on it. What? That's not fair. It's encouraging people to go invest in energy. It's also stinks if I go and I spend all this money and I come up with what's called a dry well. There ends up not being any oil and gas there. So it's kind of a way for Congress to reward companies for going and digging for oil and gas or other natural resources. Again, I just use oil and gas a lot because we see it so much in Texas. So that's a weird rule that throws students off a lot. Y'all are used to thinking, yeah, rightly so, we shouldn't expense any more than the cost of it. But with depletion, and specifically only percentage depletion, we can in fact deduct more than what it cost us. So that's my depletion video.